Good morning and welcome to today's Leadership Huddle webinar hosted by NIC. This morning's Huddle is a conversation with brokers during a pandemic. I'm Chuck Harry, NIC's Chief Operating Officer, and I'll be facilitating incoming questions during for this morning's panelists. Before we begin our discussion, let's review the webinar's technology and logistics. You've joined using either your computer speaker system or your telephone based on your audio access during your most recent GoToWebinar session. You can adjust your audio access to this morning's webinar through either your computer speakers or your telephone using the settings in the audio pane, which is located on the top of the control panel on the right side of your computer screen. We welcome your questions for our panelists during today's webinar. To submit a question, type your question in the questions pane, also located within the same control panel on the right-hand side of your computer. You may submit questions at any time during the webinar, and select incoming questions will be answered following the panelists' discussion. For those questions not answered during the webinar, we will strive to follow up with individual responses following the conclusion of today's webinar. For those of you on Twitter, our hashtag for this webinar is #NICLeadershipHuddle. Now that we've addressed the webinar technology logistics, please welcome my associate in NIC's Chief Economist, Beth Mace, who will introduce this morning's speakers and begin our discussion.
Great, thank you, Chuck. Welcome everyone. This is our 6th NIC Leadership Huddle webinar. We started these webinars, for those who have been able to join us, in the middle of March in response to the need to share information in these unprecedented times of the COVID-19 pandemic. And we continue to hold them because so much uncertainty, unfortunately, still remains in the market today. The impact of COVID on the seniors housing and care sector has been significant, especially to operators who continue to work around the clock to protect residents and support frontline workers. Many of the challenges that were evident in the early days of the pandemic remain, unfortunately, still in challenge, especially when it comes to testing and tracing. And we at NIC continue to support all efforts associated with the adequate provision of PPE, testing and tracing for the safe operations of seniors housing and care properties. In addition, and in a continuation of our mission, NIC encourages transparency in our understanding of the virus. As the COVID-19 pandemic has developed, it has become increasingly clear that the availability of data on the seniors housing and skilled nursing communities is vitally important. And NIC is engaged in numerous initiatives to collect, analyze, and distribute COVID-19 relevant data on the seniors housing and care sector. And we are truly grateful to the many operators and capital providers who continue to provide us their data, even during these very difficult times, so that we can bring transparency out into the market. These data contributors, as I indicated, are improving transparency, which leads to credibility and ultimately trust by educating not just investors and other operators, but also policymakers and the general public. Now, without further ado, let me review the outline of today's webinar, and then I'll let the speakers introduce themselves. So I have 7 topics, key topics that I want to try to address in this next hour. So it'll be a little tough, but we'll see what we can do. First is, how do you actually underwrite during a pandemic? If there are a few deals that are getting done, how do you underwrite? Are all care segments the same? Does IL been responding the same way as AL versus skilled nursing? Has the risk profile changed for seniors housing and skilled nursing investing? Will it change? Will it be the same as it was pre-COVID, or will there be more risk associated with our sector? When will we return to business as usual, or even will we return to business as usual? Have expectations for key metrics and returns performance changed? And is there any perspective we can gain by looking at history? And finally, will there be some kind of distress opportunities out there? At the very end, we'll do a little bit of a lightning round where we're talking about underwriting assumptions by each of our panelists. So now let me start to introduce our panelists, starting with you, Charlie.
Thank you, Beth. Well, my bios are on the screen. I won't go into a lot of detail, but I'm with the JLL, National Seniors Housing Group. We have a team of about 12 professionals and support people. We are working daily on investment sales raising debt and equity for development properties, financing existing properties, and advising clients in other matters. And thought it'd be interesting. I've had terrible timing in my career. We talk about cycles. So I first got into real estate in 1986, which is when a little thing called the S&L crisis hit in Texas. So lived through that, and I can tell you that was probably the deepest cycle that I've seen in my career. And in Texas, it was, not a deal was getting done for a period of several years. Then my great timing continued when in 2008, I co-founded the ARA National Seniors Housing Investment Sales Group right in the middle of the Great Recession. So I've seen a few cycles and learned how to get through them. And I do know there's light at the end of the tunnel here with the COVID pandemic.
Great. Thank you for joining us today. Hey, Ben, can you introduce yourself to the audience?
Sure. Thanks, Beth and Chuck and Nick for hosting what I envision to be a very captivating conversation and in a dynamic environment, to say the least. Blueprint, a couple of partners and I founded in 2013, and we've rapidly grown to do roughly 100 transactions every year. 50% of those are historically have been skilled nursing and 50% have been seniors housing. And we remain busy today, certainly in a shifting landscape, but very busy and still closing deals, still open for business, and really sitting as a resource as we see more opportunities and transactions than just about anyone out there, trying to figure out how to crack what's shaping up to be an interesting landscape, to say the least. And hopefully we can add value to this conversation today.
Great. Thank you for joining us. And Rick?
Sure. Thanks, Beth and Chuck, for inviting me to this conversation this morning. I'm really looking forward to it. I head up our 14-person National Senior Housing Capital Markets team. We're active in every aspect of the capital markets for senior housing, which is, ranging debt, equity, and investment sales. And we cover everything from active adult through IL, memory care, and CCRCs, as well as skilled nursing. And like the others, we are also very active today. There's always a demand for capital. It's just in some different formats today. So looking forward to the conversation.
Great, thank you. So let me start with you, Rick. Broadly, what's been the impact of COVID-19 on your business so far?
Sure, I'd say, from a broad perspective, it's slowed down a little. We had a lot of things in the pipeline that we were packaging, starting to market. Those deals that got, signed up pre-COVID ultimately have closed, some with some adjustments. I'd say the product that we were in the market for, depending on the nature of the seller, some were plowing through and others have asked us to kind of put things on hold to see when things become a little more normalized. But now we are getting some new requirements. Refinancings, people that are having to restructure their debt situations, some sales where people just have needs for liquidity, or they may have had very successful projects that are still doing well, and they don't want to, sit around for who knows how long, and they want to test the market. So again, we're busy, but it's different.
Okay, Charlie, how about you? What's been the impact directly on your business?
Yeah, very similar to Rick. At the time COVID hit the U.S., we had about $2 billion of assets somewhere in our pipeline, either in marketing or under LOI or under contract. And the vast majority of that has the vast majority has been put on pause. Some of the transactions have continued to move forward slowly. There are significant barriers to getting a transaction done at present. Everything from how do you get a lender in to tour the building, how do you get your third parties done, how do you effect a license transfer, how do you even record the deeds when in some cases the county offices are closed. So those barriers have really slowed the transaction flow down. Like Rick said, we are starting to get more inquiries. I'd say the last 2 weeks have probably been more active than all of April and May put together in terms of calls and people wanting to talk about, starting to look at going back to market, looking for financing, looking for equity for new developments even. So we are starting to see signs of life, and I hope that continues to carry forward.
And Ben, how about you? Same thing or a different phenomenon?
Yeah, I think we're seeing a lot of the same themes here, Beth, to what Charlie and Rick are seeing. Certainly, a lot of the stakeholders on both the buyer side and seller side are taking a wait and see type of an attitude. And then we had a little bit of a pause from the capital markets. I think it's loosening up a little bit, particularly the banks have paused as they didn't know exactly how this was going to unfold. I'd tell you that, like I said earlier, half of our business is skilled nursing focused, and that industry, that sub-market has been impacted perhaps more greatly as it relates to the actual census and operating expenses, but it's a little bit more resilient and need driven, and the capital markets and the buyers and the cap rate environment continues to prevail. So we're seeing that market, even though directly impacted more significantly, seeing that as a little bit more resilient and a little less of that wait and see type of position from the marketplace stakeholders.
So Ben, on the skilled nursing, is there any element of that because it's not private pay and because it's government reimbursed? Has that been adding any type of confidence to investors?
Yeah, well, that's a great question. And we're seeing all sorts of stimulus money being sent directly into the nursing home industry with a big announcement about a week ago. That could be temporary relief, but certainly is making people able to pay the bills, pay the rent, service debt, et cetera. We're also seeing HUD get a little more lenient with their process and their criteria, and they're able to get through some of the site visit obstacles and get through to financing. So that's playing a role. And then I tell you that the market, the behavior of the buyers in the market is a little bit different. It's unique than what seniors housing buyers typically, how they behave, which is more in line with commercial real estate traditionally, that approach. So interesting time, like I said earlier, even more impacted perhaps on a direct basis from the revenue standpoint, because even though government is paying for those residents, the censuses are dipping, and perhaps more resilient in terms of our ability to transact.
Okay, so that's good. I think that we're starting to see things loosen up a little bit, and so those deals getting at least beginning to come back. But how do you actually go about underwriting? And we'll start with you, Charlie, on this, because there aren't a lot of comps, right? So basic things that you have to do when you underwrite, you have to make some assumptions. You have to look at comps. How are you doing that when the market's limited in the information that it's providing to you?
Well, as you said, there aren't that many sale comps, so we're not really even trying to look at comps right now so much. It's very much property by property, and it's very much focused on discounted cash flow. So, take the pre-COVID financials, see what happened to the property during COVID, and then make some reasonable go-forward assumptions over a 5 or 7 year hold period. So, some properties experienced a significant hit to occupancy. We've heard some dropping 10, maybe even 15%. Some, on the other hand, have really experienced no change. So obviously the underwriting for those two properties would be quite different. In terms of rental rates, a lot of the investors are saying they don't expect much rental rate growth for the next 18 months. But in tight markets, you may see some growth. So again, very, very property specific, but we'll make specific assumptions about each property and what's reasonable going forward. In terms of expenses, we've had elevated expenses due to COVID in relation to the purchase of PPE, to hero pay, and to higher staffing expenses just overall, using agency and other sources. So depending on how aggressive you want to get, you burn those down over time. What we try and do is talk to the buyers, find out what they're doing. And if the buyers are forecasting a burn down of those expenses over 12 months, that's how we would model it. And then the other big thing that comes into play is the finance. So, initially, the lending market was frozen for probably 2 months. As Ben was saying, much more open now, and rates are attractive for Fannie, Freddie, and HUD. So you're able to layer that debt in and do an after debt cash flow analysis. And really the key thing is returns, and the leverage cash flow returns for most of the investors we're talking to haven't really changed. They're still seeking the same type of leveraged return. They're just being more selective, and they may stress test that cash flow a lot more aggressively and run a lot more variations to determine their pricing at the end of the day. But just to summarize, very much individual property focused and very much cash flow focused, not necessarily cap rate.
So on the cash flow basis, have you increased the level that you're putting in, like your fixed costs associated with PPE? So are you assuming that there's a higher cost just to have business, just to do business as usual as businesses come back?
Yeah, I mean, really the two things that are impacting expenses are the PPE purchases, and we are forecasting those will slow down over a period of time, and maybe you have some for 2 years, and then we should have a vaccine, and you would forecast no continued PPE expenses. And then same with staffing costs; those should ramp down, over time. And what we are seeing is that most operators are isolating their PPE and staffing cost expenses. So we're seeing on operating statements specific line items that reference COVID-related expenses. Mm-hmm. So the expectation is that over time, when we're looking back, buyers and lenders will recognize those as one-time non-recurring expenses, and the properties will not be hit with those going forward. And any operator that's out there that's not isolating those expenses, you should be.
Okay. Ben, how about by sector or by property type, care segment? What are the differences that you're seeing? Is every property the same, or what makes each property different?
Well, at first, I completely agree with Charlie. We're spending our time far more arguing what forward-looking NOI looks like or EBITDA looks like, as opposed to arguing cap rate. Our position on cap rates is they haven't changed, at least yet. So we are underwriting one-time expenses and trying to put those, quote unquote, below the line where possible. PPE purchases, labor, certainly something that we are battling with investors and buyers and trying to negotiate what is permanent here to stay in terms of escalated operating costs. I think you're seeing some of the themes in skilled nursing, but on an enhanced level. So again, arguing NOI, not necessarily cap rate. I think cap rates on SNFs in particular will be more durable and will stay the same. There's a far greater equity premium, and then we'll get into that conversation later. But from a leverage standpoint, I think on the seniors side, you're seeing still attractive rates from financing, agency and bank and non-bank financing, but you're seeing sizing go down, which is an indication of risk and how the institutions are looking at risk. So that's going to affect, perhaps not dollar for dollar, but it's going to affect pricing eventually. And then I think, like Charlie, we're also seeing on the seniors housing side, the pro formas, particularly on the revenue and the rate growth assumptions, stretching out to longer time horizons. So that's going to impact the seniors business. Skilled nursing, I think in the short run, we're going to see Medicaid rate increases in various states, which is going to help and probably outpace that seniors housing private pay rent growth acceleration, which is going to be tough given the trickle down effect into people's endowments, the consumers' endowments, their home values, and the different elements of the economy that affect willingness to pay for seniors and their families, jobs, and the like. That's not going to be as relevant in seniors housing, or in skilled nursing rather, that is far more based on entitlement programs and reimbursement rates. So again, I think the theme is you're going to see seniors housing hopefully in the long run prevail and do fine, but perhaps short term see a little bit more of a dip despite having an actual direct impact to skilled nursing, but it's more durable in the short run.
Okay, Rick, your thoughts on this? And one question in particular, are the agencies requiring greater reserves in terms of interest reserves and things like that? And is that affecting underwriting? Oh, can't hear you.
Yeah, the agency requirements for reserve sizing definitely tightened up. You know, we're finding the balance sheet lenders are starting to thaw out, and so we're finding some success there as well. But you know, I would agree, you know, then Charlie, we don't think the IRR requirements, levered IRR requirements have changed, but you have to underwrite in a lot of detail the cash flow. I would say we still do look as a metric, we'll look at stabilized NOI with a traditional cap rate as a starting point sometimes. And then we'll maybe deduct out of that, you know, kind of your capitalized costs for additional COVID related expenses over say 18, 24 months. And we'll do the same thing for, you know, for occupancy that, and, you know, even pre-COVID, we were used to marketing a lot of properties that were still in their lease up. Maybe they were 80, 85%. And so we might look at a 92, 93% stabilized occupancy for a cap rate, but then you've got to net out of that, you know, in essence, the shortfalls to get there. So we're looking at that build up, and then we're looking at the, you know, the levered IRRs as well. But what we're hearing from the buyers is that they don't really see a big yield impact in terms of what they're looking to achieve. And they're looking for safety in terms of those first, you know, 12 to 24 months. So I think we're going to see some structured deals as well to kind of help compensate for that.
What would be an example of a structured deal?
Structured would be some type of, you know, yield guarantee over a period of time. That typically works best when you're doing kind of a recapitalization where you have the same operator stay in place, because, you know, nobody wants to guarantee something that they're not matching themselves. But as long as that operator is staying with a new capital partner, then maybe there's a holdback, or if there's a credit-worthy entity to backstop it, it may just be some kind of guarantee. But that would allow a buyer to pay a more traditional value for the product, knowing that he'll kind of get through the short-term expense issues and occupancy issues.
So they're sharing the risk to some degree.
Exactly.
Yeah.
To try to heighten the sales price. Yeah.
So let's stay on risk for a second. Do you think that the asset class has become more risky? We see headlines, you know, daily in papers about what's going on. Sometimes there's confusion on what's the difference between seniors housing and skilled nursing, but you know, certainly on their front pages all the time about the more of the risk associated with this asset type. What do you think that is going to do in terms of investor interest, and what will that do to pricing?
What we're hearing from the investors is that, I mean, one, I think they're happy to see groups like NIC and ASHA and others working on the PR side of it, because I think that the industry has performed better than the news has, you know, presented. But yeah, our sense is there's a lot of capital in the market. The groups that we know that were running funds are still raising capital, and I think they believe long term, you know, the demand for senior housing is not going to change. In fact, we all know demographically it's going to keep growing. It's a need-based service. So again, I think the risk is associated, it's a short-term risk. It's an operational risk getting through the COVID phase, but I don't think people view it as a long-term structural risk.
And what about the economy? Because you throw the economy on there, so you know, the numbers look pretty dark for second quarter GDP probably through the end of the year. And we know that in the last recession that the more choice-based independent living was more effective than was the need-based IAL. So throw the sort of layer of the economy on top of that. And does that have any impact on risk?
Well, it certainly can, although it's been interesting. One, we're seeing strong housing markets in most of the major cities. I think maybe some of that is people, moving out of the urban and moving into some of the suburbs. But we are seeing the housing markets seem to be resilient. Clearly, the users of senior housing, the future residents, are not worried about losing their job. So it's not an employment issue. Once in a while you hear about the adult child that's maybe lost a job, and that, limits the ability to support their parent, but I think that's the rarity. So it seems that the senior housing industry could weather the recession pretty well, just because, again, the need base.
Okay. Charlie, what do you think about that? Do you think that the sort of risk profile of the sector has changed, or there's a lot of capital on the sidelines, dry powder, so to speak? Is that going to allow pricing to stay where it has been?
Yeah, I mean, there's tons of dry powder. When you look at all the large funds that have been raised, some dedicated to seniors, like the PGM almost $1 billion fund, and others that are more blended, Harrison Bridge, et cetera. There's just tons of capital, and those guys are not going to give the capital back to their investors. They're going to deploy it. They're going to deploy it in a thoughtful manner, and they're going to try and get the returns they've promised. So that will continue to lead to strong demand for seniors housing product from the investment community. As far as the greater risk profile, I think, obviously we're in a turbulent environment right now, as Rick was saying, and there's greater risk to everything. I mean, there's greater risk to going to the grocery store right now than there was. But, this should be a short-term situation, and we expect things to gradually improve. And just the phone calls we have with investors and operators, it seems like every call I get is a little bit more optimistic. People are becoming accustomed to dealing with the COVID situation, the travel restrictions, the lockdowns. New solutions are being formulated. We were talking yesterday about how to do virtual tours and using some of the new technologies out there like Matterport to help facilitate tours. And operators are starting to use those tools as well. So I agree with Rick that the long-term outlook for seniors housing hasn't changed. And there could be a few kind of side effects of this situation that benefit us. We could see a slowdown in new development, which will eventually result in increasing occupancy levels. We all know we've been in a market which was a little bit soft because of too much new development. So, that slowdown could be good. We've also seen a decrease in construction prices, and that will allow projects that do get built to price themselves a little lower, which will open them up to a wider market. And I think long-term, the labor market is going to be much more favorable for seniors housing. We were battling with an unemployment rate of, under 5% in most markets, and seniors housing was competing with many other employment sectors, some of which now are going to be much more loose, such as the hospitality sector, restaurant, all service industries. So I think seniors housing operators are going to find that the labor markets are much more favorable for them, and we may not see the type of wage increase that we were seeing. So long term, very bullish on the sector. Short term, certainly going to see some continued turbulence.
Ben, where do you weigh in on the sort of the dry powder on the sidelines? Are they ready to come back in, or do they need to see some type of changes in the industry, or will the equity premium change? Has the risk premium changed? Any of that?
Yeah, I think that's a really central question to pricing here. And I agree with Rick and Charlie in terms of the 10 billion plus equity committed to the sector. I don't think that's going anywhere, and it will be deployed. I think the underlying question really is, do I want to put my loved one in a seniors housing community right now? And I think that you're going to see some of the traditional metrics like penetration rates maybe go backwards for a little bit. And then I think the idea of coastal core cap rates and pricing metrics that commanded a premium that actually are sitting in dense markets that may have more risk. You might see a little bit of an inversion in that dynamic. You've got a lot of offsetting factors. I think a deceleration of new supply is going to play a role. I do think that we got, as an industry, very close to multifamily and underthought some of these unforeseen risks, like what a pandemic could do to our occupancy and revenue, and in turn the operating expenses to try to curtail it. So I wouldn't be surprised to see a slight uptick in cap rates in the medium run. But again, what I think is causing our team to continue to be optimistic is that there's so much capital on the sidelines that needs to enter into the space. It will support pricing in the long run.
Well, then you look at senior housing against other property types as well, and compared to office or maybe multifamily, certainly retail, likely not industrial. Any thought? I'll open it up to all three of you in terms of how senior housing compares to some of those other property types.
Yeah, well, I think that we saw last recession, last time around, seniors housing was really last in, first out. And I think we hopefully will see that again with therapies and vaccines and different ways to contain the pandemic here. I mean, what's on my mind in personal life is retail is changing. I was talking to a broker friend of mine who focuses on net lease investments last night in shopping centers and pharmacies and the like. I think that business is going to be changed dramatically, far more than seniors. And then I think the office sector, man, I think we're going to see some serious changes fundamentally to that business on the long run. And I don't see any way that it changes anytime soon. So that's certainly on my mind. And if I was an institutional investor that was multi-asset class focused, like a PGIM, for example, I'd be thinking more about seniors, and perhaps I'd look at the risks a little differently. But compared to those other alternative asset classes, I like the story, and I like the 80 million baby boomers coming online, and I like eventually that story of putting your loved one in a seniors housing community to come back with a vengeance. So I'm optimistic.
Okay, Charlie, what are the key metrics that our listeners should be paying attention to? Have they changed? Where will they be in a year? So, for example, IRRs, cap rates, PP. What are some of the key numbers to be paying attention to if I'm thinking about the sector and where they were and where they're going to be going?
Well, I think the most important is the levered IRR, and that varies by asset class. So your A plus, your trophy properties, those were selling many times for levered IRRs below 10. So high 7, 8, 9 range. Then you move up to different to the next higher quality and on up. So your B's and C's are low teens. Then you get to the more opportunistic or value add assets. Those are 15 to 20. Development deals, high teens, or possibly into the 20s. That's really the key metric. I think the other thing to continue to look at are the expense ratios. And historically, when you look at seniors housing over the long term, revenue has changed at varying ratios. Expenses have changed at various percentages, but the margins have tended to stay very similar. And what that has told us historically is that operators have been able to raise income to match increases in expenses. They've been able to match up revenue with expenses and maintain that profit margin, whatever it is, call it 35% for assisted living. You look back historically, that's been very consistent. So looking at that on a go-forward basis is, I think, very, very insightful. It's probably changed for the short term due to all the related COVID expenses. But if we return to that level, that should give us a good indication of what NOIs will be in 1 year, 2 years, 3 years, et cetera. It's also a great thing to look at on properties where you're getting a pro forma from someone. That's really the first thing I look to is the profit margin. And if the profit margin is considerably out of market, you know something is off with the deal.
So a 35% margin on AL, what would that compare to for IL or for apartments?
IL can be, upwards of 40, 45. And, I couldn't even tell you what an apartment profit margin would be. I know on 55 plus, that can be up, around 50.
Yep.
So I'd assume apartments are probably, above that.
Yeah, my experience is probably about that as well from prior work I've done. Yep.
Yep. And, I don't think price per unit is that big of a factor, but I will say in prior cycles, we've seen more attention paid to replacement costs. And I do think we may see that come into play a little bit more in the coming year, as investors are going to be very careful that they're not overpaying for an asset. And one of the things they will look at is, what would it cost me to replace this asset today in the market? And
so where was that pre-COVID? The replacement cost versus pricing?
Yeah. Well, in many cases, investors were paying prices well in excess of cost to acquire assets that they truly wanted. The question is, does that continue, or do investors start to, on those types of assets, be a little bit more conservative and look at cost as a ceiling, which has happened before when we went through the Great Recession. A lot of investors looked at replacement cost and said, we like this asset, but the pricing we get from capping the NOI is 20% more than cost, and we're not going to pay more than cost. So that could come into play. I'm not saying it will, but that's something that we have heard a little bit more focus on of late.
Yeah, I mean, there's a series of I think, different measures that you look at, and you sort of look at them all, and they balance each other. So there's not usually one single metric that you pay attention to, but you look at it in the holistic point of view.
Absolutely.
So let's switch for a minute to talk about distressed assets and distressed opportunities. So Rick, starting with you, do you think that, we've seen potentially a lot of stress in the market? If we look at it back at other economic cycles and other real estate cycles, there's usually a period that sort of a reality sets in, that things have changed and things have switched. We saw in the last cycle for broad commercial real estate, prices and values went down about 25%. Took a number of years to come back up. There were a lot of opportunity funds that entered the market to take advantage of that distress. Seniors housing last time didn't have nearly the same valuation decline, and as you pointed out, Ben, it sort of came back much faster, last in, first out, like LIFO. So, Rick, are you hearing about more distressed funds out there? Or are you hearing calls from people saying that they're looking for distressed assets? And if yes, where would those be?
Yeah, I would say we're getting far more calls for the assets than we're seeing the deals. There's a lot of PE capital out there that has been waiting years for the opportunity to buy on a distressed basis in the senior housing space. I think what we're seeing is, though, that those deals are starting to happen now, and it's often a scenario where there was distress in the asset pre-COVID, but everybody was kicking the can down the road. And then when you hit COVID, everybody said, oh, this is going to get worse before it gets better. Maybe a lender's now getting involved. And so we're seeing, a lot of pressure to move these assets, and we're seeing a lot of buyers. So we're getting, we're just going to contract now on a $100 million 3-asset sale. One of it was a C of O deal. The other ones were, struggling on occupancy. Tremendous amount of activity. We're, just finalizing a sale of a memory care portfolio, straight memory care, which again had a fair amount of stress going into it. And now with COVID, obviously, the price per units have plunged, and there's a lot of players for that kind of product. So yeah, I think we're gonna see quite a lot of activity. And as I said before, a lot of it will be lender driven.
Do you think it'll be any single markets? Like, for example, going into before COVID, the occupancy rates were lowest in Atlanta. Those are average occupancy rates. So there were some properties, obviously, that were doing quite well and some that were doing less well. Dallas had low relative occupancy rates, Houston, or is it pretty much across the nation that we'll see opportunities like that?
We see the stress much more asset related than market related. You know, if you've built a good product, you usually can manage your rental rates and get up into some rational level of occupancy. But if you have built something in the wrong location, the wrong configuration, something that just didn't meet the market, you know, you're really stuck at a low occupancy. And those are the ones that we see, and they could be anywhere in the country. We've seen them happen in the midst of very strong markets and sometimes weaker markets. But again, I think it's more asset driven than market driven.
And Ben, will those be distressed? Will they be distressed opportunities, and will they be recaps, or will they be what will be the structure of what will happen on those weaker assets?
Well, I think you saw all three of us chuckle when you brought up distress, because we're all thinking the same thing. We're thinking, God, these guys can't stop calling, looking to bottom feed and go get a deal. And I just don't think it's there yet, really, Beth. I don't think that wave of distress, I think that bid-ask spread is still too wide. And then you got so many bidders and so much money and some buyers out there that eventually that's going to support pricing. So I don't think we're going to see an environment where these deeply discounted deals, these sweetheart deals, they're going to be coming few and far between. That's what I think.
But at the property level still has to prove itself out. You still have to be able to generate a margin in your NOI.
No question. But I think you're going to see stakeholders. I think you're going to see lenders more patient, more forgiving, at least in the short run. And I think you're going to see those investors that were financially motivated perhaps wait. And that could actually be a wrong decision to not pull the trigger on a sale, because we might find ourselves in an environment where perhaps the COVID pandemic doesn't go away as fast as everyone would hope. Maybe cap rates go up a little bit. And we're sitting there answering that question, thinking about it with our clients right now. And I tell you that the groups that we're really seeing transact in this marketplace are not necessarily worried about that.
Okay, there was a phrase that we had, I think you might have stopped recording there, Ben. But let's continue. There was a phrase last recession that we had, like extend and pretend. You heard a lot of lenders doing that. Is that relevant today, Charlie?
Absolutely. And I don't know that I'd call it pretend yet, but certainly we are aware of a number of situations where loans were due on properties, within the last few months, and lenders have agreed to extend on a short-term basis those situations in order to facilitate the owner bringing in a new capital partner or a new lender. I think the other thing, when we talk about distress, and I agree totally with Ben, I don't think we're going to see that many deep discounted deals, but it applies to situations. And there's two situations where we're seeing a fair amount of activity. And one is, as Rick was mentioning, properties that were perhaps newly constructed within the last few years, still in lease up, and those interest reserves and operating reserves are dwindling or have been totally used up. In that situation, something has to happen. And that could be a recap, that could be a refinance, that could be a sale. The other situation are the net lease properties. And, most of the REITs are not doing net lease deals anymore. And I'd say the number of those still out there is not significant. But if you are at a 1.0 or 1.1 or even a 1.2 to 1.3 coverage prior to COVID, you're probably negative now. And you're probably going to be negative for the next 12 months. And how long are those operators going to feed those deals? And once you go negative on a lease, it's hard to get it back into positive territory. So I do think we'll continue to see a string of renegotiated leases with the REITs, and with the REITs potentially selling some of their net leased assets, in many cases back to the operator who may be bringing in new capital, or in some cases selling them to a new owner who will bring in a new operator. And that's not really distress, so to speak, but there certainly are some good opportunities there.
So I think it's important when we talk about that like changing of ownership of operators, and I think all of us recognize it, but I still like to point it out that, that when you change an operator, that's a stressful situation for a lot of the residents in these properties. So my experience has been that it's done very delicately and done with a lot of thought to make sure that even if there is an operator that switches managing a property, that it's done as seamlessly as possible with a lot of lead time to have that transition occur. I don't know if you would agree with that, but that's been my observation.
Absolutely. Yeah. Any change in operator is stressful to the residents, to the staff, to the ownership, to the operators. It's a stressful situation all the way around. It can be a very good thing for a property, but it certainly is stressful.
Yeah, and I think that sort of is a comment on the industry as a whole. It's different than an office product because this is a caring and an operating business where we're taking care of people. So I think we've seen that in the COVID crisis, because we've seen, the frontline workers and the staff and the residents themselves have been foremost among both capital providers and the operators, debt lenders, equity groups, REITs. And that's been really welcome to watch. Not that unexpected, but really welcome to watch from my point of view, to see that there's been this cooperation and this teamwork.
Yeah,
so
no, the operators are doing the tough job, for sure. Just saying, the operators have the tough job. We have the easy job. We sit back and talk about what might happen to values, but they're on the front lines every day. So I have so much respect for what they're doing.
Yep, agreed. So I want to leave time for questions with the audience, but real quick, I want to do a lightning round real quickly for our listeners. So, when you do underwriting, you have to make assumptions. And since there seems to be a little bit more activity going on right now, according to let's start with wage growth assumptions. And according to the Bureau of Labor Statistics, for assisted living, average hourly earnings were up by 6% pre-COVID. This was in late last year. Now, that isn't necessarily how you're underwriting your assumptions on wage growth, but can you give me an example? We'll start with you, Rick, of wage growth assumptions going forward in a deal that you might be underwriting now. Is it like 3% across the board, or is it 6% across the board, or 2%, or what's the sense of that? Oh, can't hear you.
Yeah, we're looking at every line item, and for example, even pre-COVID, we were seeing some significant bumps in insurance, and we're working with a consultant now to try to underwrite that, because particularly when you have a change in ownership and/or operator, you get stung on insurance, and COVID just heightened that issue. So we're looking carefully at an issue like that. I would say with regard to wages, we think actually the unemployment situation, and particularly in the hospitality industry, is going to have a benefit to the wage rates in senior housing. It's going to increase the labor supply. So we're not quite as concerned there. So I would say in most categories, we are using 3% long-term growth rates. But again, looking at line items that might be impacted differently.
Okay. So just as a quick aside, in the NIC Insider, which is coming out this week, there's a lead interview that I've done is about the insurance industry and what operators can anticipate for the rising costs associated with COVID on it. Okay, Ben, wage growth, 2% across the board for you? Can't hear you. Charlie, let's go to you while we're waiting for Ben.
Okay. Yeah, I would say we'd look at pre-COVID trends for the property, and if it's going up 3% a year, that's probably what we'd forecast going forward. And again, we'd isolate those COVID-related increases and see those tail off over time. So it's really two separate line items.
Okay.
Can you hear me now?
Yep, we can hear you. Yep.
Oh, great. all these hot takes must have overheated my webcam or something. I don't know. Labor, short term, I think your statistics were underwriting something similar to what you saw in fourth quarter. Long term, I agree with both of these guys that hopefully there's some offsetting factor that relieves some of the wage pressure out there.
Okay.
So long term optimistic, a little lower in terms of growth rate.
Okay. All right, staying in the lightning round idea of quick responses. Occupancy rates today, according to NIC data in the first quarter, was for senior housing 87.7. One of the important underwriting assumptions, of course, is what you're thinking about occupancy, and that feeds into the NOI and your returns. So a year from now, starting with you, Ben, occupancy rates for seniors housing, 87.7 in the first quarter.
Yeah, my guess is in the short run, and by a year from now, we won't quite get back to that level. We'll probably be somewhere around mid 80s, 85, and then eventually long term, we'll get back to where we need to be.
Okay, Rick?
Yeah, again, I think we're going to have, a dip, and then we'll recover as new residents are able to be brought back into projects. But it's going to be slow. So yeah, I agree with that. We're not going to get all the way back in a year.
Okay. Just for those who don't know, NIC is conducting a weekly and bi-weekly survey on occupancy, move-in, move-out. That's our executive insight survey that you can get on our website, www.nic.org. Okay, Charlie, how about for you for occupancy a year from now?
I'm going to be a little more bullish. I think we'll be back to this level. I think we will see a dip, but we're also hearing from some of the operators that there's starting to be some signs of pent-up demand. So I'm thinking that we may see that recovery happen a little bit quicker.
Okay. All right, I'm going to stop there, and Chuck, I'm going to pass it over to you for questions from our listeners.
Sure, thanks, Beth. We do have what seems to be a fairly optimistic audience in terms of the sector going forward. So there's a number of questions related to new construction or new development. One of those is your expectations in maybe particularly as it relates to the skilled nursing sector in terms of mandated improvements to the properties going forward. Is that something that any of you expect on a go-forward basis and potential relative costs associated with that?
So a specific question on SNFs as it relates to capital improvements, is that?
Yeah, in particularly, Ben, as potentially mandated improvements going forward.
Well, I mean, HUD's going to play a role in any building that it finances. So, and that's a good majority of the skilled nursing debt out there. I think this is going to vary by state as the skilled nursing industry does. So you're going to see some states that are a little more loose, particularly those states where there's not a CON and new construction can come in. Those other states that there's a limited supply and barrier to entry, higher barriers to entry, you're probably going to see a little more mandated CapEx in those buildings.
Rick or Charlie, any thoughts there?
Yeah, the only thought I'd have is I think you're definitely going to see a movement away from any type of shared accommodations, especially in skilled nursing where that's more common.
Okay. Another new construction related question is, and Beth kind of touched upon general market occupancies, but what about assumptions in terms of lease up for new properties, both seniors housing and skilled nursing?
Well, I think the question is, are you referring to something that gets started construction today, which means we're really not leasing for 18 months, or are you talking about something in lease up today?
It's more something that may be coming out of the ground in the near future. So whereas maybe had previously pro forma, say, 15 to 24 months. Now, are we looking north of 2 years for a lease up period?
I don't think so. I think what you're going to see is both developers and capital sources being much more particular in terms of markets and locations that they will build in, because they're going to want to build into markets that they feel are constrained enough from a supply perspective to support that traditional lease up, versus going into a market that's already seen a tremendous amount of new development and could have that slower lease up.
I would add, not even just market focused, sub-market focused. So you dissect the market. We've got a deal right now that's got a 40-person wait list on a new construction deal that just completed its lease up. So I would say that it really varies by property and sub-market more than even just market in general.
Okay. Charlie, anything you'd like to add?
And I think the lease up pace will be at least what it was historically. And, the other thing, we are right at the beginning of the boomer wave coming into seniors housing. They hit 75 next year. So if anything, I think, if you look forward 2, 3, 4, 5 years, you may see an increase in the pace of leasing for the newer properties.
Interesting.
So I wanted to give each, because we're going to be at the top of the hour in a minute, any final wrap-up comments that Rick, Charlie, or Ben, you want to provide to our group?
I just want to commend the industry for doing a great job in a very fast time frame to get their arms around these issues and to manage very effectively, and to actually now moving into a new phase where we're seeing some stabilization of operations and some new leasing. So again, my hat's off to all the owners and operators out there.
Yeah, I concur. I think the front lines folks are incredible, what they're doing to support the industry and the people in it. Hats off to them. I'd also like to just acknowledge Nick for doing this, and then also the recent announcement on the tough decision to make the NIC Fall Conference virtual. Hats off to Nick for making that decision. It's the right decision. We're going to miss everybody. That's one of our favorite times of the year as an intermediary, to see everybody we talk to on the phone, but it's the right decision. We're fully supportive of it.
Ben, one clarification. You still will be able to see each other, just not in person, but virtually. So we welcome everyone to join us for that fall conference in early October. Charlie, any final comments?
I'd just echo what Rick and Ben said. Thank you to everybody that's on the front lines. You're doing yeoman's work out there, and thank you to Nick and Asha as well for all the work that's being done to promote our industry and get good information out there to the people that need it.
And
appreciate the invitation to speak today.
Yes, thank you all for your insights this morning. It's very much appreciated. And Nikki, if we could pull up the closing slide, because we'd like to welcome our audience to join us for our next NIC Leadership Huddle webinar, which will seek to answer the question, business as usual or time to think outside the box. The upcoming webinar is scheduled for 2 weeks from today, Thursday, June 18, and again starts at 11 a.m. Eastern Time. To register for our upcoming webinar and for ready access to a variety of pandemic-related market information, please visit the NIC COVID-19 Resource Center at nic.org. As NIC remains committed to continually improving these webinars, we very much welcome your candid feedback. You're encouraged to complete the survey you'll receive following the conclusion of the webinar. And then within the next 1 or 2 days, you'll receive an email with a link to download the presentation and view a recording of today's webinar. On behalf of Nick, Beth Mason, myself, as well as our panelists, Charlie Bissell, Ben Firestone, and Rick Schwartz, thank you for having joined us. Please stay safe, maintain your physical distance, but stay connected. This concludes today's webinar.